say you could go and change like one rule, or make up one rule, or remove one rule or regulation within the US stock market. Like, what would be the thing that you would focus in on to try and make it maybe a more fair and transparent market?
I think that's a really hard question to answer, mostly in that market structure is relatively complex, and as soon as you start to sort of pull a thread, you realize how interconnected everything is. So I'm going to cheat, and I'm going to say I have to at least get two rules. But the one rule that I would really focus on is what I call the trade at rule, or the minimum price improvement rule. And this is something that most other markets around the world have. And what it says is, if you want to execute a trade off of an exchange, you have to provide a minimum amount of price improvement. And that price improvement in the Canadian style of the rule, they say it has to be at least a full tick if the spread is more than a tick wide, or at the midpoint if the spread is a tick wide. And the SEC proposed something very similar in this new set of rules. It's called the order competition rule. And it basically says, it's an even more aggressive form of a rule that I just described. It says, if you want to execute something off exchange, you can only do so at the midpoint, regardless of the spread. Otherwise, you have to send that order to an exchange or to these what are called these qualified auction facilities, which, as I was talking about before, there's some controversy in the way that the SEC has designed the auctions. But I think that rule would do more for market function, transparency, price discovery, and competition than anything else. Now, the reason I say you can't just do that rule is because there's also this rule. It's called the access fee cap. And what it says is exchanges can only charge 30 mils a share for an order that takes liquidity.
Okay, so
that's okay. Yeah.
Brief interlude, and now we're back.
Okay.
So where were we?
I want to say, I described the rule that I think would be most important, and I think we're very close to getting it. I think that there has never been a time when we've been closer. Now, I've been pushing for what I described. I've been pushing for that since 2012. So we're 11 years in. And the rules that the SEC proposed in December came very close. They didn't quite do it in the right way, but they're very close. And the industry has pushed back against some of the rule proposals from the SEC because, for example, this retail auction facility, that's a big unknown. We don't have something like that in equity markets. There is something like that in options markets, but you don't want to you don't want to say, oh, let's do what the options market is doing, because that's like a whole clusterfuck in itself. So, it's the equity markets. It's reasonable to say we shouldn't try something we haven't tried before. And the beauty of the trade at rules, we actually tested that during something called the tick size pilot a few years ago, and we saw really good results. So we know in U.S. equity markets that a trade at or minimum price improvement rule could work, that it would give us good results, that there wouldn't be unintended consequences, and that it's very similar to what the SEC has proposed in the order competition rule. So what I'm working on now is trying to convince the SEC to listen to the comment letter that we the investors wrote, that was filed by thousands and thousands of people, that said, this is good, but it could be better, and here's the right answer. And I found that there are a lot of folks, both at the SEC and even in Congress, on both sides of the aisle, that are very receptive to these arguments. So I'm going to be stupidly, maybe naively, cautiously optimistic, being that it's been 11 years that I've been trying to get these, them to consider these, and not just me, lots of people. This is, these are ideas that are a lot of other people have as well. And I really do think that this is the first SEC in which it's actually a realistic possibility. And so, I'm going to keep pushing for that.
I mean, that is cautiously optimistic, actually. So let me ask you something that I have long suspected. I feel like if you were to go in tomorrow, right, in this hypothetical, wondrous scenario, and just do what, many retail investors want, and just sort of snap your fingers and go, okay, we're going to clean this up. We're going to make everything transparent, and there's going to be like an actual, I don't know, I don't even know what you would do specifically, but like just go in and be like, look, there's going to be no more of this naked short selling. There's going to be no more of this sort of false price discovery based on like the worshipping at the altar of infinite liquidity. And there's going to be like full transparency, no more dark pools, no more off exchange trading. I feel like the entire stock market would fall to pieces. But that's just, maybe that's me being a bit too cynical. What do you think?
I mean, I would hope it wouldn't. I would hope that much of the functioning of the markets is working, and there are things happening in the margins that need to be fixed. And that might sound, I think for people who, for example, are just focused on GameStop, they might think there's nothing else that matters, and that's fine. I understand that perspective, but this is a multi-trillion-dollar machine, and a lot of companies come to it to raise money or to, I think you see a lot of price discovery happening, and you see things that move on news. I think there are there are stocks that are manipulated. I don't think there's any doubt about that from anyone. Maybe people would argue over which ones are manipulated, but market manipulation happens. There's no mystery to that. It happens on the long side and pump and dumps. It happens on the short side on with short selling and abusive short selling and manipulation. I've measured it and created reports and helped companies take action around this abuse. So, I've seen it statistically and quantitatively. I've seen court cases that, uncovered some pretty crazy shit. And there's no doubt that that's happening. I think the question is it pervasive? Is it the entire market? Would it fall apart? I don't think so. But I do think that there are parts of the market where where firms are offsides to a great extent. I do think there are serious issues with what's called proxy plumbing, right? Which really has to do with voting and governance. And I think that's an area that a lot of people should be concerned about, because I think your rights as a shareholder include oversight and governance of the companies that you're invested in and the ability to vote. And that right is often stripped away or truncated and tossed away, unless you're directly registered or unless your broker is doing things in the right way. So I think there are all sorts of problems in many areas, but no, I don't think I would go so far as to say the whole thing would fall apart. I do think there are a handful of firms who might get blown up if that were to happen, and I won't argue that there would be systemic issues from it. I'm not saying that. I think the problems are big enough that they're systemic and it's a serious issue. But I still think the market functions pretty well in lots of situations, and that's probably not a very popular view. But that's how I see things.
Yeah. Hey everyone, thanks for making it right the way to the end of the podcast. I love that you tuned in this long. Do me a favor, hit subscribe, because 80% of you bastards are not subscribing, but you're watching my videos. See you next time.